this year so far. In fact, representing confusion and indecision, well, it could be confusion and indecision because obviously we still have high inflation, but we've now got an easing story starting to form. So your narrative is like, what the hell? I don't understand this. Well, we do understand it because we can obviously look at this from a different perspective. We can look at this from the Fed funds, the Fed release from the previous day. Anyway, so I'm not wanting to get too committed to the next move until London. So I've already told you I'm selling high prices. I'm not selling, anything else. I'm waiting for that seller to come in at high prices because that's keeping me as safe as I can be as an outright trader. In a normal trade, I'd be looking to smash bonds, right? Smash bonds, sell side massively on bonds as a normal trade. But look at my second part to that tweet. Smash bonds short from, okay, so it's a continuation, short from these levels and buy cheap 10s against it. Do you see that? Buy cheap 10s against it. It'd be very unusual if the spread widened further. In other words, this is primarily a spread trade. So I'm thinking that this is probably going to have that spread quality about it. In other words, I'm telling you, when I tell you there's a spread trade, what am I telling you there? This could be a parallel, right? If I'm telling there's a spread trade there, I'm telling you this could be a parallel. And it's a parallel easing, which is buy-side equities for presses, right? So this gives us a couple of clues about this. If you ever see me talking about primarily looking to do a spread trade in bonds, my biggest concern is that this is a parallel storyline. Otherwise, I would not be interested in a spread trade because there's no value. I might as well get it in an outright if I know what direction we're going in. Spread trades keep you safe from parallel shifting markets. And this is a great example of a spread trade keeping you safe from a long duration. This went on for 2 days for a parallel shifting market right there. Now, the one thing you'll probably be able to recognize is that these events take place kind of almost in a predictable fashion, don't they? What do I mean by that? Well, if you look at what caused this, it was obviously coming in from Friday. So what happened on Friday? What happened on Friday, the 6th of May? Not a lot, right? There wasn't something that you can see anything in there, or do you notice anything? Sorry, do you notice anything in here on Friday? The 3rd of May, my mistake. I was wondering where the 6th of May was. The 3rd of May. Does anybody notice anything? What happened on Friday, the 3rd of May that caused this storyline? The non-farm payrolls, right? So on Friday the 3rd, the non-farm payrolls came out, and what did the non-farm payrolls tell us? Well, of course, they obviously tell us something of very, very significant importance because we're not going to see a spread as massive as this in a normal environment, are we? It's not going to be normal for us to see something as big as this as a narrative, right? So these are all incredibly important storylines, aren't they? Yeah. So the non-farm employment came in really, really weak at 175,000. The forecast was for 238,000, correct? You all remember? Non-farm employment came in at 175, a very, very weak number. So if you get a very weak number, what kind of market response would you expect to a weak number? Easing or tightening? Easing or tightening? Easing, right? So if we get a weak number, the kind of market we're expecting is actually a bull steepener. In some respects, when you're looking at the overall shape of this, it's looking as if it's because it's being generated by a drop in the, it's not generated, some people might say, but it's a steepener. I don't understand the steepening part. The steepener in that environment isn't generated by the 10s going higher, it's generated by the 2s going lower. Do you understand? So we'll borrow Garand for a second here, and we'll illustrate this. So let's assume that this is the interest rate curve prior to the non-farm payrolls, okay? So this is the 2s, 10s prior to the non-farm payrolls. And then, of course, we get the non-farm payrolls coming out, and the NFP comes out as a very poor number. Well, obviously, that doesn't necessarily have any impact at all at the 10-year end. Very little impact, in fact, at the 10-year end at this stage of the narrative. But obviously what happens is if we get a very poor non-farms, what's going to happen at the 2-year end? Well, the 2-year end is going to drop significantly, right? So what's going to happen is we're going to get that type of pattern there, right? So obviously what happened to the 2s, 10s curve? It bull steepened. Does that make sense? It bull steepened. And if it bull steepened, this is a model or a paradigm shifting event, isn't it? And a lot of the times we end up getting a parallel shift. Now, there's only a certain number of events that would have that capability, isn't there? There's not very many events every month that we would imagine could cause that. Well, one of them could be, of course, non-farm payrolls, as we've just identified. CPI's, of course, got the ability to do that as well. And obviously, central bank releases. So, for example, minutes or speeches from the top people. So it could be a speech from the top person, or or of course actual rate decisions that surprise the marketplace. That can also be a reason. So these are the events that can cause these things to take place, right? So we always know coming into something like the non-farm payrolls, for example, when we look back at this, we know that there's always the chance that this type of event can take place at exactly that point, right? At exactly that point, we would establish the fact that if this is a really weak number, that is a real possibility. That bull steepening, QE, recalibrating, repricing of the Fed can, in real time, take place. So we're acknowledging it, we're recognizing it as a possible thing, and we get ready, perhaps, we have to take advantage of it. Even if we could do that, that would be nice. So as I said, we don't have to be that worried about it for most of the time, but the times we do have to be worried for it, of course, is when we hit things like inflation numbers, heavyweight inflation numbers. When was the next event? Well, the next event was on the what? The 15th of May. What happened to US inflation numbers? Well, they were quite weak again, weren't they? They came in at 0.3 headline. So on the 15th of May, we know that the inflation came in at here it is here. So where is it? Sorry, that's not it. Yep, there it is. So Wednesday, the 15th of May, there it is. So there's your CPI print coming in just there. And again, the same thing happens. We get the big spike higher, just exactly the same as what happened here. We get the big spike higher, the big drop, and then the rally. And then what happened here? Well, we got the big spike higher. We got the drop. So we're now kind of looking at that and saying, I think there's a possibility that we're going to get a parallel in this. It wasn't a ridiculously low number, right? It's not crazy low, pricing in a Fed movement in rates, but it's certainly low. So you're thinking to yourself, I think there might be an element of steepener in this. So obviously it means that you simply just don't sell bonds, right? And obviously there it is. There's the trade, right? There it is. There's your trade. You see it? Do you see the story? It's almost identical. Does everybody get that? So when we understand that there's a story behind that, this is normal, or what we would term normal. You know, this is post data type information here. The challenge you've got is, where is it? Where is that normal environment? That's going to be the biggest challenge following these data releases, because these could be real tough eggs to crack. These could be real challenges to figure out where the hell that trade is. Now, the easiest way to think about it is, you know, and it is find your level. Now, the problem of finding a level is what? There's usually not going to be any levels to the left-hand side, is there? Because a parallel shifting market is a driving paradigm shift. So the only thing we can normally do is we start watching for the wholesales, usually the big zeros, because obviously the big commercials will want to book their profits at the zeros because that's where the liquidity is at. So in these big moves, we start basically watching for the zero prints, predominantly the zeros. So as we come away from this price, obviously, and the parallel starts to kick in here, as we break that price, the first zero print is going to be 23. Well, that's not probably far enough away, is it? So the price after that's going to be 24. And as we go higher, you can see that 24 hits right there. Well, guess what? There's your 24 right there. Do you see that the sell came in at exactly 24? See that? And the price collapsed off the 24. Why? Because the 24 will always contain big volumes. A wholesale price with nothing to the left will always contain big volumes. When this one happened, obviously we got the spike up to 25.5. So you're obviously automatically looking at 26 for a big sell, yeah? Can you see the 26 for a big sell post data? You see it? There's your 26 sell. There's your 24 sell. How crazy good are those trades right there? So when we move along to today's Fed announcement, I don't have that level until 25 kicked in, did it? But remember, this was a Fed data release. It was the Fed minutes. It wasn't non-farm payrolls. It wasn't the Fed, and it wasn't CPI. You can see that the big spike here and the big spike here, it didn't take place, did it? It wasn't really the same, was it? It's not as strong a parallel shift is what I'm saying. So if it's not as strong a parallel shift, we would imagine we should be able to make some money by doing some rotations. So instead of using the idea that we've got to be 25 or nothing, I can simply look to the left and find levels to lean against. And remember, I can't do this trade unless I'm at top edges. I'm not going to be a seller down here. I'm not going to be a seller in here. If I don't get top edges, I'm not going to be a seller anywhere in a parallel shifting market, because that's my one slim guarantee that I'm going to be safe in a market like this. My one slim chance of survival, if I get it wrong, is that I'm at a good price. And the worst case scenario is maybe I scratch out and I have to rework the narrative. It's one of the most, if you're a bond trader or a gold trader perhaps as well, a dollar trader. So this isn't just about bonds for all you guys that think we're just talking about bonds. This is a storyline that gave us the buy on equities off of those imbalances, for example. And that buy on equities, by the way, guys, on a 2% risk, you can obviously understand that we hit out at a top line price of 16 times our money. So with 2% risk, that trade was worth 32% today on that one buy trade. The buy trade, again, was at a price of approximately 18,950. And the top line price was 1923. And in terms of 1% risk, that was a 16% reward, 2% risk, 32%. That's maximum swing. You're never going to get maximum swing, of course. But nonetheless, a crazy, crazy reward for just recognizing a parallel shift. How important is that from a fundamental point of view? You will not get this information anywhere else. You will not get this information, well, I don't think anywhere else in the retail space. because they simply just don't know about it that well. They don't understand it that well. You're not going to get, your retail gurus talking about this as a thing, because they're not getting this storyline of easing and tightening properly analyzed. And, there's the observation, and then there's the tradable opportunity. If it is bull steepening, just acknowledge that it's bull steepening. It doesn't mean you can't be a seller. Just acknowledge that it's bull steepening. Call it as a bull steepener. And then it keeps you safe in terms of trying to fade equities, for example. Call it out. And then try and get this fade into the top edges if you're comfortable, but only the top edges. And therefore, the tweet became indispensable because the tweet told you, if this is a spread trade, just know, guys, that I am worried about that bull steepener. And that means you should not be selling anywhere but top edges. Anywhere but top edge prices. And that's how we've managed to make money selling bonds today, because we waited and we waited and we waited and we hit it when we got the chance. Crazy good stuff, right?